Our next guest thinks the Fed's next move will be to tighten, but he says that doesn't necessarily mean rate hikes. Here to explain is former Fed governor and former NEC director Larry Lindsey. He is now CEO of the Lindsey Group. Larry, it's been a while. It's good to see you. Welcome.
Good to see you. Glad to be here.
I'm trying, Stan Druckenmiller is there, Gary Koza. If any of them, can you nudge them? If any of them would like to come and share some reflections about them. But I know people want Warsh to have his moment in the limelight.
Right.
What do you think his first steps are going to be as Fed chair?
Well, he's confronting an accelerating inflation situation. The last 12 months, we had inflation of 3.2. Annualized for the last 6 months, it was 3.7. And annualized for the last 3 months, it was 4.4. So you have an accelerating trajectory, and that's one thing you really don't want to see. So I think the new chairman is going to have, and his colleagues are going to have to do something reasonably quickly to reassure the markets about this.
Now, Joe Livornia was on yesterday, Larry. I don't know if you caught this. He cited the exact same stat that you did, 4.4% annualized core inflation over the past 3 months, and said as a result, the Fed should hike by 100 basis points.
Well, I don't think they're going to do it all at once. I think if they go the rate hike route, again, it's up to the chairman and in the incoming data. My bet would be if you're going to get there, you're going to do 50 the rest of this year and 50 in the first half of next year.
But you're saying we shouldn't rule that out.
No. Well, let me throw out a little statistic, which always is helpful. The Fed's research says that the neutral Fed funds rate is real between 0.5 and 1. So let's pick the middle number, the 6-month number. That's 3.7. That means the neutral Fed funds rate is between 4.2 and 4.7. We're a long way from there. So you need at least 50 bips in order to get to the lower bound of neutral, and need 100 bips to get to more the higher bound of neutral. And remember, neutral, it means just that. It means you're not accelerating inflation and you're not decelerating inflation. So there has to be some increase in Fed funds.
Although you also think his first move to tighten is going to be on the balance sheet side of the equation. Is that right?
Well, he said that. We'll see. Kevin is a very persuasive guy. He's just said he wants to lead a reform-oriented Fed. So good luck to him. But I think in the end, when he looks at the pros and cons of raising the Fed funds rate or tightening the balance sheet, selling off the balance sheet, he'll find that going the traditional route of using Fed funds rate is going to be the way to start. I don't know if in this environment it's a good idea to start off with something new and radical.
Do you think these price pressures are transitory, Larry?
Some of them are, I'm sure, but you know, the numbers I gave were the core PCE deflator. So the PCE deflator generally runs below CPI, and it was core, so it took out the effects of oil and food. Well, you know, oil is probably the biggest transitory factor, if in fact there is transitory factors out there. So I think you do have underlying inflation in the economy.